7 things about money that banks don't want you to know. Henry Ford, an industrialist and a business magnate, almost a century ago, talked about how the majority of Americans simply do not know the way the banking system works, because if they did, there would be a revolution before the next morning. Almost a century has passed since he made this statement, yet nothing has changed. People still look at the idea of banks as a bad omen, but banks actually provide us with very useful services and have become an essential part of everybody's life because all of us want to keep our money where it's safe and secure, right? Why would anybody nowadays want to put their money under the mattress, under the rug, or in the back of their closet when there are institutions, aka banks, that can keep our money completely safe? Banks are cashing out big time most of the time at the expense of the gullible public, but because of the financial institutions operate in complex and rigorous structures, some unusual practices are kept hidden from the prying eyes of the public. It doesn't matter which side of the coin you choose, we're all in this together one way or another, whether you're taking a loan, spending your money, or saving it. There are numerous ways that banks make money off of you, and the sad part is that you don't know that you're being milked. The diversification of banks' income streams may be one of the reasons why bank stocks have become an investor's delight. Now, let's take a look at 7 truths about money that banks don't want you to know. 1. You're losing money every year. Although all of us have probably heard that banks are the best option to choose when you want your money to be kept safe, nobody tells us that by keeping money in the bank, we're actually losing bits of it every year. The question is how? And this doesn't have anything to do with someone stealing from you or with the fees you pay for your spending. It's actually because of inflation, which is the increase in the prices of goods and services over a certain period of time. This basically means that if you buy with a $50 note today, it will cost slightly higher next year and much more in 5 or 10 years. So thinking that the money in your bank account is safe means that you expect its value to remain the same over the years or even grow bigger because of interest, right? You see, every investor's wish is to keep up with inflation, but this is not the case with most bank accounts. On average, inflation in the US is around 2%, so if your money in the bank yields 0.5%, it means that you're losing somewhere around 1.95% on the value of your money every year. And to be clear, this is not the money that you have invested in financial platforms to yield returns. It's the money that you have sitting idle in your savings account. 2. Banks earn from your card transactions. Did you know that every time you pay something with your credit card or debit card, the bank makes money through processing fees? You may not know about this if you were only debited for your actual purchase, but the merchant pays the fees, which he also may have included these fees in the sales price so his profit wouldn't come short. For example, if you purchased an item that cost you $500 and paid it with your credit card, the merchant is charged 3% on every payment made with a payment card. In other words, $15 from your $500 purchase goes to the bank. So basically, the bank gets the money for providing the machines and the convenience of payments. But the merchant won't be happy to pay these $15 to the bank, so you're actually the one paying instead of him. And let's see how. Let's say there's an item that's supposed to be sold for $480, but the business owner raises the price to $500 because the additional $20 will cover the 3% deduction which goes to the bank for card transactions, taking into consideration that the majority of people would rather pay with their cards. Because banks make so much money through card transactions, they offer a lot of incentives just to encourage you to sign up for a credit card, not letting you know that the interest rate for a credit card is 17% and that it can be raised for up to 2% mostly. They can do this very shortly after you receive your credit card, within just 2 to 4 weeks, and you can't do anything about it because you actually don't read and simply ignore these letters that contain lengthy legal jargon. If you have compound credit card interest, it will just continue to accumulate, which will eventually work against you because not paying off these debts leads to a financially difficult situation. This doesn't mean that credit cards are bad, it simply means that you should take a bit more care in order to not accumulate debts that will later be very hard to pay off. 3. Your money in the bank is not physical. It is very important to understand that no matter how much money you have in the bank, these are all just records, and that money may not really be sitting there the whole time because banks are using this money for their business, so it may be used to give loans or mortgages. So while your money is in the bank, it is really all over the place making a profit for the bank. And while this is simply the way the whole banking system works, maybe you should always have at least some cash with you because in case a crisis occurs, like the one that happened in 2008, people go to banks to withdraw everything they have on their accounts simply out of panic. And when everyone is running to cash out the money they have in their accounts, banks simply run out of physical cash as a result of the fractional reserve banking policy, which allows your bank to lend out your money to those who need them in the form of loans and mortgages. Again, this doesn't mean that banks are not safe places to keep your money because your money is always protected by insurance. There's also the government that's ready to step in case something goes wrong. So don't worry about your money in the bank because it is completely safe. Just keep in mind that having money in the bank is just like having it in a box that you can access anytime, and although your money is busy making more money for the bank right now, you can still access it whenever you want. But if everyone wants their money at the same time, then no one gets it. 4. Bankers are not your friends. Although your banker often calls you to chat up, knows your name, knows when your birthday is, congratulates you on all your anniversaries, and simply seems friendly, before you know it, you're hooked. But always keep in mind that this is part of their job. They don't love you, and they are just following a well-rehearsed script, waiting for the right time to strike. You see, bankers do and say all these things to you. They earn your trust and make you feel like they're on your side and not on the side of the bank, and then they talk you into a loan you probably didn't even plan. It's like taking a $50,000 line of credit that you never planned for, but it simply happens with this type of so-called friendship. All that bankers care about is money. It's the targets they get from their managers, and if they don't hit them in time, they lose their job. And the reality is that if bankers really cared about you as a customer turned into a friend, then they would never hit those targets because they wouldn't pursue you to take a loan. 5. Foreign transaction fees. This is another way banks make money from their clients. Your bank will never tell you this, but when you travel outside the US and make purchases with your credit or debit cards, you get some additional charges. The reason majority of banks want to disclose these foreign transaction fee charges is that if you knew this from the beginning, then you would of course dump them and go for different money options. There are some credit card programs that cover some countries outside the US, so when using your cards in these countries, there will be no additional charges on your purchases. 6. Always check your accounts. Money is the medium that allows you to live the way you do, to have food, a place to live, and basically to afford any activity you like. That's why it is important to take care of it, and the best thing is that it's so simple. All you need to do is regularly check your accounts. I know most of us are lazy to do that, and just the thought of regularly going to the bank kills us, but in today's year and age with banking apps that we all have and use, it takes just a few seconds to log in and check if everything's alright. This way you'll notice if some hidden charges that you know nothing about are in your record. So in case you notice a charge that's not yours, be quick to report it to your bank, because if you make a report within a 90-day window by law, your bank has 48 hours to return the money to your account. Your bank, of course, doesn't like when the client knows this, so they often try to delay the process or to even get out of it. But you can stick to your guns because you're legally protected and they're obliged to credit your money back to you. 7. You're being watched. Banks are required by law to report any suspicious financial activity to the IRS, and because of that, they keep track of all your financial activities. The IRS policy is there to check suspicious deals like money laundering, so every deposit or withdrawal that exceeds $10,000 is reported to the IRS. And when it's needed to audit your account, the IRS comes up with inquiries demanding an explanation for such transactions. What happens is that first the officials would like to know whether you paid taxes on the funds or not. Then they would like to know if the transactions were legally carried out. The message here is that whatever you do with your money, always keep in mind that you're being watched and avoid making mistakes. This brings us to the end of today's video. Don't forget to like and subscribe, and make sure to hit the bell button so you can get notified whenever there's a new business related video ready for you to learn from.